Every single day, millions of traders look at red and green candlesticks to navigate modern markets. Whether you're actively managing a complex portfolio of derivatives or maybe just glancing at the latest financial news on your phone, you intuitively understand this visual language. Green means up, red means down. It is absolutely the foundation of modern technical analysis. But behind the digital glow of your brokerage app lies this incredibly profound system that literally predates modern software by centuries. Welcome to This Explainer. Today, we're not just looking at boring charts. We're going to explore the fascinating history and the ancient alchemy of candlestick trading. We'll be diving into how an 18th century system, one that was actually designed to track human emotion, became the undisputed visual language of global finance.
Okay, let's dive into this. It's incredibly easy to look at today's financial markets and just see cold, hard data, right? We operate in this era of hyper-fast algorithms, quantitative easing, and supercomputers that execute trades in fractions of a millisecond. But I want you to step back in time with me to the 1700s, to the bustling Dojima Rice Exchange in Osaka, Japan. Long before any of our modern technology even existed, Japanese merchants were engaged in what was essentially the world's first true futures market. They didn't have silicon chips, they didn't have fiber optic cables. Instead, they had physical couriers, literally running across rooftops to signal prices from town to town. I mean, they were trading rice coupons, effectively betting on future harvests. And in this incredibly dynamic, intensely physical marketplace, these traders were already doing something extraordinary. They weren't just crunching numbers or tracking supply. They were mapping human emotion through price movements, developing this incredibly sophisticated technical framework centuries before computers were even a dream.
Section 1. Munehisa Homa's profound discovery. Now, out of all the merchants operating in that era, one name stands out as the absolute architect of this methodology, Munehisa Homa. Homa was a legendary rice trader from Sakata, and his approach to the market was wildly ahead of its time. Initially, he did exactly what any thorough analyst today would do. He amassed decades of historical data. He painstakingly studied weather patterns, annual crop yields, and seasonal trading volumes just to fundamentally understand the price of rice. But after compiling all this objective, fundamental data, Homa had a massive breakthrough. He realized, and this is absolutely crucial, he realized that the fundamental data alone was not dictating the price. Panic over a bad weather report or unbridled greed during a really good harvest caused the actual trading price to deviate wildly from strict supply and demand logic. He deduced that underneath the basic accounting, the true driver of price is raw human psychology. The market is effectively a living organism completely driven by fear and greed. Section 2, the anatomy of candlesticks. Now, what's really interesting about this slide is how Homa actually took this abstract idea and made it visual. Having realized that emotion dictates price, Homa needed a practical way to track those invisible feelings on paper. Western charting methods, which would develop much later on, traditionally relied on simple line charts or bar charts, and those mostly prioritized just the closing price. But think about it, a closing price tells you absolutely nothing about the emotional journey the market took to get there. Homa's revolutionary solution was the candlestick. By plotting the open, the high, the low, and the close for a specific period, he created a visual block that encapsulated the entire intraday emotional journey. The thick body of the candle showed the net result of the session, while the shadows, or the wicks, captured the extreme price fluctuations. It wasn't just a record of a number, it was a comprehensive footprint of market sentiment mapped out over time. It's like a giant puzzle piece of human behavior. And this brilliantly illustrates how when you view a candlestick through this historical lens, it ceases to be just a static block of data. It becomes a live, dynamic conflict. It is a literal battle between buyers and sellers, captured within a specific time frame. Let's think about the actual anatomy of this conflict for a second. Imagine a candle with a massive upper wick. That long wick isn't just a record of a high price. It represents a graveyard of aggressive buyers. It shows an area where buyers push the price up with intense optimism, only to be violently rejected and overpowered by a wave of sellers, who dragged the price all the way back down before the session even closed. That wick is a visual map of emotional capitulation. The buyers pushed, the sellers countered, and the resulting shape tells you exactly who lost their nerve. Homa was essentially reading the psychological momentum of the crowd, using these shapes to predict exactly when panic was peaking or when greed was completely exhausted. Section 3. Ancient Alchemy, Modern Markets.
For over 2 centuries, this highly effective visual system remained a localized secret in Japan. Japanese traders quietly used candlestick analysis to navigate their domestic equity and commodity markets, and they maintained a massive edge while the rest of the world just relied on standard bar charts. It wasn't until the late 1980s that this ancient alchemy finally breached the walls of Western finance. The story goes that legendary trader Steve Neeson was working at a major Wall Street brokerage when a Japanese colleague introduced him to these strange, intricate charts. Neeson was absolutely captivated. I mean, he spent years tracking down obscure Japanese texts, hiring translators to decipher centuries-old trading manuals, and rigorously backtesting the concepts against Western markets. When Neeson finally published his findings, the idea spread like wildfire. It took Wall Street by storm. He essentially proved to global financial institutions that this 18th century Japanese system offered a vastly superior way to visualize market data. Almost overnight, candlesticks completely replaced Western charting methods on trading desks around the entire world. So the crucial point is understanding why this methodology survived centuries, crossed oceans, and fundamentally replaced existing global standards. It's actually incredibly simple. While the underlying assets have completely changed, going from physical rice coupons in Osaka to digital tech equities on the Nasdaq, human psychology remains completely identical. The exact same fear that caused a trader to dump his rice contracts in 1750 is the exact same fear that causes a modern trader to panic sell a cryptocurrency today. Munehisa Hama's brilliance was recognizing that while technology and assets will always evolve, the underlying mechanisms of human greed and panic are timeless constants. By visualizing that emotion, he created an immortal analytical tool. It is wild to realize that every single time you pull up a chart to analyze a modern corporate earnings report, you are fundamentally relying on an 18th century methodology designed for grain merchants.
Which leads us to a really fascinating thought. If our hypermodern algorithms still rely on an ancient language designed specifically to track human emotion, are we really trading numbers, or are we just trading our feelings? It undeniably highlights the enduring, inescapable role of human psychology in our highly technical world. Definitely think about that the next time you see those red and green candles flashing on your screen. Thank you so much for joining me for this explainer, and never stop questioning what is really driving the data.